Don't get trapped in the next market crash. Blind faith in figures like Warren Buffett is leading retail investors straight into disaster. Where are investors putting their money? What's the Fed planning with rates? And how overpriced are stocks right now? Well, it doesn't matter. If you want strong returns or at least avoid losing money this time around, stop following what famous investors are doing. What really matters is mindset, because mindset decides who wins when the panic ends. Nervous investors always hand their money to patient investors. It's been that way every single bear market. The cycle never changes, but this time the crash will be even tougher. And even with all the information out there, company reports, sector analysis, political information, most investors will still lose. In fact, they might lose because of all the information overload. A bad season in the stock market isn't just red numbers on the screen. It is nervous investors practically shouting, "Here, take my money." The question is, are you ready to take it? Well, it isn't as simple as buying whatever nervous investors are selling. Which stocks should you buy? How many? Have they fallen enough? When will they rebound? That is where mindset separates winners from losers. Step 1. Stay rational. The deeper the panic, the harder the sell-off. No matter how strong a company's fundamentals are, balance sheets don't suddenly collapse, but stock prices do. Business models don't vanish overnight, but nervous investors act like they do. Companies are the same as they were a month ago. What changed is investor psychology, and that shift is completely rational, which is why independent thinking is everything. So, is it really just nervous investors creating bear markets? Yes, but it's worse than you think. Falling prices trigger panic, even for the best. Take Warren Buffett in 2020. The pandemic crashed airlines. Delta stock lost more than 60% in a single month. For value investors, that looked like a once-in-a-decade opportunity. But Warren Buffett sold. He dumped his entire $1 billion Delta stake, saying the world has changed for airlines. In the months that followed, Delta stock doubled. The greatest investors of all time, selling at the bottom, against his own principles. He had billion investment thesis on Delta's value, then abandoned it in the middle of panic. That $1 billion went straight into the pockets of patient investors who bought the dip. That's the lesson. The real opportunity shows up when others forget their own homework. They research, they buy, then panic hits, and they sell. The question is, are you ready to buy what they give up? Step 2. Stay focused. History is clear. Bear markets are always followed by recoveries. Doesn't matter if the cause is politics, bubbles, or overpriced sectors. Patient investors keep buying or simply hold on. They trust the companies they own, not the noise outside. Remember Delta, even Warren Buffett panicked. And today, the noise is even louder. Social media and every CEO's comment hits the news instantly. The S&P trades over its historical average. The Fed is preparing cuts. AI looks like a bubble. Headlines scream chaos. But most of this kind of information is incomplete, biased, or outdated. No one knows exactly where the market will go in short term, which is why you must focus on your holdings. As Peter Lynch said, you don't need to know everything about the market. Focus on what you understand. Look at AI leaders like Nvidia or spin-offs like Vernova. Both went through rough seasons, but strong management and fundamentals carried them higher long term. That's the power of intrinsic value. Step 3. Accept volatility, but don't try to time it. Wait too long for a lower price and the stock may bounce before you ever buy. Jump too fast on a weak company and it might never recover. Timing may be a trap. In bull markets, everyone makes money. In bear markets, only the disciplined survive. Volatility is the test that separates the strong from the weak. And if you're not ready to take advantage, at least do nothing. Yes, literally nothing. When fear takes over, sometimes the smartest move is to step aside and let the storm pass. As Peter Lynch put it, the hardest thing in investing is often to do nothing. Bear markets are where the real separation happens between nervous investors and smart investors. The ones who panic hand over their money. The ones who stay rational, focused, and patient take it. Ignore the noise. Accept volatility. And remember, you don't need to predict every twist of the market. You just need to avoid being the one who sells at the worst possible time. In the end, bear markets don't destroy wealth. They transfer it from the impatient to the patient. The only question is, which side will you be on? That's it for today. You've been watching a spin-off bull. If you enjoyed this video, hit like and subscribe. That helps the channel grow and brings you more market insights.